If investing feels confusing, risky, or like something you should have started years ago, you aren't alone. Most people lose money not because they start too early, but because they start wrong. By the end of this video, you will know exactly what to do with your first dollar without guessing or gambling. Stick around, because near the end, I'll show you the one mistake that wipes out beginners, even the smart ones. This video is specifically for you if you're looking into investing for beginners but feel overwhelmed. Maybe you have a small amount of money saved, no background in finance, and a very real fear of losing what you've worked hard for. If you've ever Googled how to start investing and felt more confused than when you started, this video fixes that right now. This is not for day traders, crypto gamblers, or anyone looking for a get-rich-quick scheme. We are building real long-term wealth. The biggest myth that keeps people broke is the idea that you need a lot of money to start. You've probably told yourself, I'll start once I have $5,000 saved up, or I need a better salary before I can even think about the stock market. This is a lie. In the world of building wealth, time is much more valuable than the amount of money you have. Consider two people. Person A starts investing $100 a month at age 20. Person B waits until they are 30 and starts investing $300 a month. Even though person B is putting in 3 times as much money, person A often ends up with a much larger nest egg simply because their money had more time to grow. Waiting to be ready is the most expensive mistake you can make. You don't need to be rich to start, you need to start to be rich. But before you invest a single cent, there is one thing you must do first, or the entire process won't work. Step 0 is building your foundation. You cannot build a skyscraper on a swamp. Most beginners skip this step, and that's why they quit after their first market drop. You need an emergency fund. This isn't about being preachy, it's about math. If you put your last $500 into the market and your car breaks down a week later, you'll be forced to sell your investments, likely at a loss, just to pay for a mechanic. That's not investing. That's a recipe for panic. You also need to look at high interest debt. If you have credit card debt at 24% interest and the stock market historically returns about 10% per year, you are losing money by investing instead of paying off that card. Paying off a high interest credit card is a guaranteed 24% return on your money. You won't find that anywhere else. Clear the high interest debt, save a small cushion of cash, and then you are ready to play the game for real. Skipping this is why people panic sell. Now, let's talk about the simplest way to actually start. When you're looking at the stock market for beginners, you'll see thousands of individual stocks, flashy apps, and talking heads on TV telling you to buy the next big thing. Ignore all of it. The simplest, safest, and most effective way for a beginner to start is through broad market funds. Think of a single stock like a single fruit. If that fruit goes bad, you have nothing to eat. A broad market fund is the entire grocery store. If one company fails, it doesn't matter because you own a tiny piece of hundreds or even thousands of the most successful companies in the world. You're betting on the entire economy, not just one CEO's ability to stay out of trouble. This is a boring strategy, and boring is exactly what you want. Boring wins. In a second, I'll show you the exact mindset that separates investors who win from those who quit. But first, let's talk about the actual math of your contributions. How much should you invest? The answer isn't a specific dollar amount, it's a habit. If you can only afford $20 a week, start with $20 a week. The goal is to automate the process. If you have to think about investing every month, you eventually won't do it. You'll see a new pair of shoes or a gadget you want and you'll tell yourself you'll make it up next month. You won't. Set up an automatic transfer from your bank account to your brokerage account. Make it so the money is gone before you even have a chance to spend it. Investing should be treated like a bill you owe to your future self. It's a habit, not a gamble. A simple rule of thumb for beginners is to try and invest 10 to 15% of your income. But if you're at 1% right now, that is infinitely better than 0. Consistency is the only thing that matters. This next part is crucial because it's where most people fail. What happens when the market goes down? This is the test of your beginner psychology. Markets do not go up in a straight line. They breathe. They go up, they pull back, they crash, and they recover. Most beginners see red numbers on their screen and feel like they are losing money. They think, I had $1,000 yesterday and today I have 900. I need to get out before it goes to 0. This is where you must reframe your mind. You haven't lost anything unless you sell. Think of a market drop as a discount. If your favorite clothing store had a 30% off sale, you wouldn't run out of the store screaming that the clothes are losing value. You'd buy more. The stock market is the only place where people run away when things go on sale. Market drops are normal. They are the tuition you pay for long-term gains. If you can't handle a 20% drop without panicking, you aren't ready to invest yet. But if you can see those drops as an opportunity to buy more at a lower price, you will be wealthy. Now we have to address the number one beginner mistake that destroys returns: the urge to tinker. This is the mistake beginners never see coming. We are taught in life that the harder we work, the better we do. In investing, the opposite is often true. The more you check your account, the more you're tempted to change things. You see a news report about a recession and you want to sell. You see a friend making money on a random tech stock and you want to buy. This emotional roller coaster is why the average investor significantly underperforms the very funds they are invested in. They buy high when everyone is excited and sell low when everyone is scared. Emotion beats intelligence every single time. If you are smart but emotional, you will lose to someone who is average but disciplined. Avoid the urge to be clever. Avoid chasing trends. If you stop trying to beat the market and simply stay in the market, you are already ahead of 90% of people. To get you moving, here is your first 30-day beginner investing plan. Week 1 is all about the foundation. Calculate your high-interest debt and set aside your first $1,000 for an emergency fund. Don't even look at a stock app yet. Week 2 is for opening your account. Choose a reputable, low-cost brokerage. Don't overthink this. Just pick one that is well-known and regulated. Choose one simple broad market fund that covers the entire market. In weeks 3 and 4, you automate. Set up a recurring transfer of whatever amount you can afford. Once that is done, your job is to do nothing. Literally nothing. Ignore the financial news, stop checking the price every day, and let the system work. This is how real investors actually start. They don't start with a complicated strategy. They start with a simple system they can stick to for decades. Investing is a long game. It is not about what happens this week or this month. It is about where you will be 10, 20, or 30 years from now. Starting imperfectly today is 1,000 times better than waiting for the perfect time that will never actually come. You now have the roadmap. You know the myths to avoid, the foundation to build, and the simple strategy that wins over time. You don't need to be a genius. You just need to be patient and consistent. If you want to avoid the common traps that catch most new investors, watch this next video where I break down the specific pitfalls to watch out for. And if you want more investing advice explained without the hype or the confusing jargon, make sure you subscribe. Your future self will thank you for starting today.